Christmas parties are canceled, holiday get-togethers are canceled, Hanukkah observations are canceled. Somehow shopping in person is canceled, but we never cancel a San Diego real estate market update. Let's see what happens in that exciting month of November. Hello everybody, this is Lenska Realty. I'm a real estate broker working with investors and always interested in your bottom line. So stay tuned for some interesting tips at the end. And here we are, the November key statistics. That's probably word traveled fast that the median home price is up 10.7% at $669,000 compared to November 2019. And the detached median was at $755,000, up 13.5%. And the median attached home price was at $485,000, up 12.8%. Looking year over year, we are at the median home price at $630,000, 8.6% increase, and the winner of 2020 so far is the detached median home price at $706,000, up 9.5%, and the attached is at $467,000, up 7.8%. So that is a pretty healthy appreciation. We might not see as much of in December, so these numbers might slightly go down. But just to make a point, what you see in the are actually nearly $1 million in San Diego, and homes are selling within 18 days. But as I mentioned before, we were at 656,000 in August, and so far in November we kind of saw the 655, and then right now at the last week in November we saw also like a 655,000 when we open up the MLS. So it looks like we are seeing a certain leveling off. Now, the rich get busy, even so home prices have been leveling off maybe, but the median is still determined by the higher priced homes. So it looks like the wealthy Americans are kind of untouched by the whole recession, and the demand for the $1 million plus homes is growing faster, which you guys can see in that pink line, which is loans above $766,000 and above. As I said, in San Diego, $1 million is just the average, but for other areas, it's pretty expensive. So let's see what some of the celebrities do. If you are Ivanka or Jared, you can buy and build in Florida, and a plot of land you can plunge down nearly $32 million. Or if you're Khloe Kardashian, you know, she did a really amazing job by doing a fixer from $7.2 million, which she bought in 2014 and just sold after a serious I think she spent about $3 or $4 million in renovation, but still sold it for $15.5 million. But not all rich get richer, so Sean had to take a little loss here, and the snowboarder, recently sold an $8 million home he bought for $10.7 million. Let's get back to the average American and the unemployment, or what I like to look at is the labor participation rate. That will give us a much more accurate picture, as obviously no doubt that millions of households have been and continue to be devastated by the economic downturn caused by the pandemic. I believe we have probably between 20 and 25 million Americans still out of work, and the situation was actually forecasted to be even worse than it actually is. And the big hope that the vaccine will, will be distributed and that the economy then should complete its comeback. So a V recovery with the vaccine should help the labor market, but right now what we're seeing is that the labor participation rate peaked at about 67.3% and it went down to about 61.5%. And as you guys in April, it has recovered, but it has recovered to where we were in 1976. All right, the current unemployment US is about 6.7, and it's about 7% in San Diego County, but that is not counting all the gig workers that are on pandemic unemployment insurance. Let's drill down a little bit on the labor force participation rate, which in the other slide, remember, it is going down. So, and it was going down, but look, with the baby boomer generation reaching retirement age in beginning at about 2008, it might seem like the participation rate for older workers has declined the fastest. But as we can see, that's actually not the case. If you're looking at the orange line at age 75 and over, it actually increased 74%, where the 50 to 55 cohort had actually dropped 1% since the year 2000. So we are seeing that a growing number of older Americans are staying in the labor force longer. Now, do we know why? I have my theory another time, but I think working is fun and keeps you fit, but maybe also out of financial reasons. So we have looked at the age group. Now look at the labor participation rate for women age 75 and over has risen about 109% since the turn of the century. The rate for men age 75 and over is up less than half the women's rate, around 47%. And again, the economy and the labor market is driven by the baby boomers. How will that affect the millennials? The more older people are staying in the labor participation force, obviously it will take jobs from younger people. And if you're looking at the unemployment amongst young people and college kids, you can see that it is unproportionately high. So we just looked at the grim labor market, and let's see how consumers feel. Here featured in the larger slide, that is the consumer sentiment, which dropped off a cliff from the about 100 line down to the 72 and barely has recovered to a 76 or 77. But the CEO Economic Outlook Index actually is at 86, which is nearly the same than it was before the pandemic. So what do CEOs know we consumers don't know? Maybe they don't know more. Maybe they just have the ability to get credit lines and funding, and also that the Fed is buying their bonds. So I'm wondering what all the IPOs lately have to do with all of this. I assume if you're publicly traded and the Fed is going to print more money and is going to buy bonds, and you, as a big corporation, you can get all the free money. And we're going from consumer sentiment to home purchase sentiment index by Fannie Mae, which it fell 1.7 points to 80 in November, and the first decline actually after 3 consecutive months of increases and recovery. But we were at some point at 91.5 in February. Here are the 5 components of the HPSI. It's about, is it a good time to buy, a good time to sell, what people think the home prices will do, the mortgage rates will do, people concerned about losing their job, and how is your household income compared to last year. So the decline in the HPSI can be attributed to net decreases in 3 of the components this month: the mortgage rate outlook, job loss concerns, to no surprise, and buying conditions. Prices have been rising, and it really pushes the affordability. But 3 components, so net increases, which is the home price outlook and change in household income and selling conditions. But still, if you're looking at that job loss concern, I can tell you that 52% are not concerned to lose their job, which means 48%, and it's still half, are concerned about losing their job. And that also the change year over year, that we have a flattening out of the household income. So with rising food prices and housing prices and flat wages, that can't end well. But the HPSI, if you compare it from homeowners versus renters, so the home purchase confidence has recovered more for homeowners than for renters, and in part because homeowners have been less likely than renters to have had their jobs and finances impacted by the pandemic. So interestingly, the gap between the HPSI broken out by the homeowner and renter subgroups hit a survey high in August, but despite narrowing slightly, remains still elevated and well above the survey average. So with other words, home ownership is pretty stable and also will build wealth and hopefully have some reserves to last out recessions where we know that renters don't have the reserves. We know that lenders had a good year since refinances were up about 70% this year. So we also know that the Federal Reserve has made it clear their intentions is to keep the short-term rates at about 0 at least through 2022. And also the Fed should continue to purchase the longer-term U.S. Treasuries and mortgage-backed securities, and which will support, lower mortgage rates. But while we think the economy and the job market and distressed households and businesses definitely need some support, and the stimulus package is still out to be decided what size it is, but the debt is increasing, and that might put pressure on longer term rates. So all that means it's going to be determined if the interest rates are going to rise possibly in the second half of 2021 above 3%. If San Diego home prices are too expensive for you, or as we know, San Diego is not a market where cash flow is king, so the National Association of Realtors released a list of the top metros expected to have the strongest housing markets over the next 3 to 5 years. Researchers factored in domestic migration, housing affordability, and consistent job growth relative to the national average, and also population age structure and attractiveness are for retirees and home appreciation. So here are the 10 markets. Maybe since we're not doing Christmas this year, maybe you guys can do a road trip and check out some of those markets. Before you jump into the car and invest out of state, stop by in Riverside or San Bernardino, which has a much better affordability, which also caught the attention of home builders. So also San Bernardino and Riverside serve kind of as a Zoom community to Los Angeles. So strong demand, and we also know no low inventory. So home builders like it, but what happens if there are not enough homes to buy? It might be also a strong rental market as we have the overflow. And we also have still people with student debt that might have to rent a few years longer. So that is one of my recommendations for you guys to check out. Season is unlike any other to cap off a year unlike any other. The holiday season hopefully brings you some strength, security, and safety. It might not be all merry and bright, but always remember you have a good realtor in your corner and on your side. Happy holidays.